Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Hey, welcome to Modern Investing Techniques, episode 61 from May 31st, 2026. I'm Patrick, coming to you from Vancouver. Let's look at what the markets are telling us today and find some opportunities. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Looking back at 8 episodes from 2026 May 25th to 2026 May 31st, the stories that mattered, what we learned, and what to watch next. The NASDAQ Composite closed the week at 26,973, up 0.2% on the day. Its year-to-date gain stands at 13.38%. The simulated portfolio sits at 0.48% year-to-date, leaving alpha at negative 12.90%. U.S. markets closed for Memorial Day, while Canadian trading continued amid oil price swings. Geopolitical tensions around the Strait of Hormuz kept sentiment cautious, even as AI chip names lifted the broader indices. While markets set records, the real story was how investors are rethinking the tools they use to keep up, starting with AI. AI-driven analytics are moving from software disruption into core Wall Street functions, such as research, trading signals, and risk modeling. The shift matters now because the same large language model techniques already used for sentiment scanning can be applied by retail investors to scan earnings transcripts or regulatory filings faster than manual review. One practical implementation is to feed quarterly reports into an LLM prompt that extracts forward-looking statements on margins and capex, then cross-check those outputs against consensus estimates. Retail investors can replicate institutional-grade research inside existing brokerage platforms without waiting for sell-side notes. This approach turns hours of manual reading into minutes of structured output that highlights sustainable cash flow signals. Bank earnings beats paired with dividend hikes offer a concrete income plus growth setup for TFSA and RRSP accounts. When capital markets revenue drives the outperformance, the payout increase signals sustainable cash flow rather than one-time gains. Today's BMO report showed net income of $2.6 billion, up 34% year over year, directly tied to trading and advisory fees. Investors can screen for banks where capital markets revenue exceeds 25% of total, and the dividend yield sits above the sector average. Then enter on the post-earnings pullback if volume confirms. Similar results from TD, RBC, and CIBC showed profits rising between 25% year over year at RBC and solid beats at the others, with all three lifting payouts. The strategy is to filter TSX-listed banks for quarter-over-quarter dividend growth above 5% and payout ratios below 60%. Income strategies worked, yet inflation data complicated the picture. TIPS ETFs are seeing inflows as investors seek inflation protection, yet the underlying mechanism often fails to deliver when real yields shift or supply chains adjust faster than CPI. The strategy involves buying Treasury inflation-protected securities through ETFs to hedge rising consumer prices, but the article shows that when inflation hits a 3-year high, the funds can still post negative real returns. This highlights the limits of single-factor inflation protection in the current environment. When macro data weakens, the filter shifts to companies that compound regardless. Enter ROIC. Return on invested capital measures how efficiently a company turns capital into profits after accounting for the cost of that capital. In today's environment of constrained consumer spending and selective AI demand, focusing on high ROIC businesses helps filter names that can compound even when macro data weakens. The approach starts with screening for companies posting ROIC above 15% over 5 years, then checking free cash flow consistency and competitive positioning. Platforms such as Wealthsimple or Questrade allow investors to run these screens inside tax-advantaged accounts without additional software. Even strong domestic screens benefit from geographic ballast. Diversification across developed Asian markets can protect against single-country policy risk, when one market like Hong Kong's Hang Seng remains far below prior peaks due to property sector liabilities exceeding $300 billion and regulatory crackdowns on major tech names. Today's conditions make this relevant because Japan's Nikkei, Taiwan's market, and Korea's Kospi offer policy risk offsets while one market stays far below prior peaks. This reduces single country concentration when one market stays far below prior peaks. Finally, one name dominated private market conversation all week. On May 20th, 2026, Space Exploration Technologies Corp. Filed its public S-1 registration statement with the SEC, converting months of draft stage speculation into a concrete timeline that points to pricing around June 11th and first trading as early as June 12th under the ticker SPCX. The filing sets roughly $1.8 trillion valuation and confirms Starlink revenue contribution, now public. Investors now have a practical three-horizon framework for deciding whether and how to participate once the stock begins trading. The three horizons cover pre-IPO tender opening day tactics and long-term hold, plus a checklist for any future listing. That wraps the week's threads. Here is the single action listeners can take Monday. This is the simulated trade for learning purposes only. Over the past week, our simulated positions included ACM on an infrastructure contract win that closed down 11.35% after rotation hit, despite multi-year revenue visibility. We also simulated APO at 15 times adjusted net income, with 15% projected organic growth. Yet it finished down 1.81%, underscoring how quickly broader rotation can erase a value setup. The pattern shows that even strong fundamental catalysts can be swamped when sector rotation accelerates. Volume confirmation on any rebound attempt would have helped avoid the deeper drawdown in ACM. These outcomes remind us that contract wins alone do not guarantee price stability once macro headwinds appear. The lesson is to pair catalyst strength with sector momentum checks before sizing up. Our earlier rule about waiting for volume confirmation would have helped here because both names saw light trading after the initial news. That experience shapes how we approach next week's screening for names with both earnings visibility and confirming flows. We will watch for any post-Memorial Day volume surge in rate-sensitive Canadian banks as a potential entry signal. The Wealthsimple screener can pull ROIC above 15% over 5 years alongside free cash flow durability in under a minute. Questrade users can layer a custom filter for TSX banks showing capital markets revenue above 25%, then sort by dividend yield. An LLM prompt that extracts CapEx guidance from filings pairs well with these screens to surface compounders before earnings season. Each tool connects directly to the ROIC and bank income strategies we discussed earlier. SpaceX tender offers remain the main path for accredited investors until the June listing window opens. The S-1 filing confirms underwriter details that retail platforms will likely support on day one. Hong Kong property liabilities exceeding $300 billion continue to weigh on sentiment for that market versus Japan and Taiwan. U.S. strikes in Iran drove crude higher, keeping energy names in focus despite overall market gains. The portfolio cumulative return stands at 0.48% year-to-date, against the NASDAQ at 13.38%. This leaves alpha at negative 12.90%, with the gap narrowing slightly on recent AI-driven days. Our AI analysis is learning from the rotation patterns seen in ACM and APO, and adjusting position sizing rules accordingly. The win rate across simulated trades remains the key metric we track internally rather than any single outcome. Now, here's something that most retail investors get wrong, and it cost me money before I figured it out. Imagine you own shares in a bank that just beat earnings and raised its dividend, yet the stock drifts lower on the day after. The mechanism is often post-earnings profit-taking by institutions that already modeled the capital markets revenue beat weeks earlier. The pro tip is to wait for volume to confirm the move rather than chasing the headline number. This separates informed entries from reactive ones and avoids the 11% style drawdown we saw with ACM. Before we wrap, keep an eye on volume patterns in Canadian banks when trading resumes on Tuesday. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't last?